5 signals, all red, all at once. John A.G., the collapse files. This has never happened outside of major crises. Here's what it means. Let's examine the pattern. In August 2007, 5 major banks, BNP Paribas, Bear Stearns, IKB Deutsche, Landesbank Sachsen, and American Home Mortgage, simultaneously announced they could not value their mortgage-backed securities portfolios. Not because the securities had lost all value, but because trading had ceased and price discovery had stopped. When 5 distinct institutions reach the same conclusion at the same moment, that they cannot determine the value of assets they've held for years, it signals that something fundamental in the system has broken. Today, in late 2025, 5 distinct economic indicators have simultaneously entered territory historically associated with recession or crisis. The yield curve has flattened to 22 basis points, seen only 4 times before major downturns. Credit standards have tightened for 18 consecutive quarters, longest on record. Commercial loan balances are contracting at a 4.6% annual rate. Credit card charge-offs have reached 5.2%, highest outside recession since 1991, and the S&P 500 trades at 21 times earnings, while corporate revenue growth has slowed to 3% annually. When 5 independent measures of economic health deteriorate simultaneously, credit availability, loan demand, consumer stress, market valuation, and fundamental growth, all flashing warnings that have individually preceded every recession in modern history, what does their convergence signal about how much time remains before the contradictions become undeniable? For most of economic history, the concept of simultaneous multi-indicator breakdown did not exist because the mechanisms that create such convergence, integrated global credit markets, synchronized central bank policies, instantaneous information flow, did not exist. Economic crises were typically sequential rather than simultaneous, with problems in one sector or region spreading gradually to others. In the Roman Empire, economic deterioration unfolded over centuries through visible stages. Currency debasement reduced the silver content of the denarius from 95% under Augustus to less than 5% by the 3rd century AD. This debasement created inflation, trade disruption, and tax collection difficulties. But these problems emerged sequentially. First, inflation in provinces where debased coins concentrated, then trade breakdown as merchants refused bad money. Finally, fiscal crisis, as the government could not collect taxes in currency anyone would accept. The sequential nature meant authorities could respond to individual problems without recognizing systemic breakdown. Each crisis was treated as isolated, a regional revolt, a temporary shortage, a military funding gap, rather than symptoms of currency system failure. Only in retrospect does the pattern of compounding failures become clear as evidence of monetary collapse. Medieval European economies experienced periodic crises, but again, these were typically sequential and regional. Harvest failures created local famines. War disrupted specific trade routes. Plague devastated particular regions. These crises rarely converged simultaneously across multiple indicators and geographies because economic integration was limited. A banking crisis in Florence did not immediately affect grain prices in England or silver mining in Bohemia. The first truly synchronized multi-indicator economic crisis in the modern sense occurred in 1720 with the simultaneous collapse of the Mississippi bubble in France and the South Sea bubble in England. Both speculative manias peaked in summer 1720. Both involved government debt schemes promising impossible returns. Both collapsed within months of each other, creating synchronized credit crises, stock market crashes, and banking failures in the 2 largest economies in Europe. The significance was not just the magnitude of losses, but the simultaneity. Investors, banks, and governments in both nations faced the same realization at the same moment, that the financial engineering supporting asset prices was fraudulent and that promised returns could not be delivered. Credit vanished. Asset prices collapsed. The economic disruption persisted for years. The lesson was that when multiple indicators of systemic stress, credit availability, asset valuations, government finances, deteriorate together, the crisis is not isolated but structural. The panic of 1873 demonstrated how interconnected economies create synchronized crises. The failure of J. Cook and Company, a major American bank financing railroad construction, triggered credit contraction in the United States. But the crisis immediately spread to Europe through integrated capital markets. Vienna Stock Exchange crashed, German banks failed, British credit contracted. The global nature of capital flows meant that stress in one major economy instantly transmitted to all others through credit channels. The Great Depression represented the first truly global synchronized multi-indicator collapse. Between 1929 and 1933, 5 major indicators deteriorated simultaneously across all major economies. Stock markets collapsed. U.S. stocks fell 89%, European markets fell 80%. Credit contracted, U.S. money supply fell 30%. Trade collapsed. Global trade volume fell 66%. Unemployment surged, exceeding 25% in the US, 20% in Germany and Britain, and prices deflated, falling over 30% in the US. The simultaneity was the signal. And when stock markets crash, but credit remains available, recovery can occur quickly, as in 1987. When credit contracts but stocks remain stable, the damage is contained, as in various 19th century panics. But when stocks crash, and credit contracts, and trade collapses, and unemployment surges, and deflation sets in, all at the same time, it signals that the interconnections between sectors have created a self-reinforcing collapse where each problem amplifies the others. The mechanism is straightforward. Stock crashes destroy wealth, reducing consumption and investment. Credit contraction prevents borrowing to smooth consumption or finance investment. Trade collapse eliminates export demand. Unemployment reduces income and spending. Deflation increases real debt burdens, forcing further spending cuts. Each factor makes the others worse in a feedback loop that continues until policy intervention or exhaustion of the downward momentum halts the spiral. The critical insight from the Depression was that individual indicators provide warnings, but simultaneous deterioration across multiple independent measures signals systemic breakdown rather than sectoral problems. One indicator, flashing red, might be noise. 2 might be coincidence. 3 suggests a pattern. 5 flashing red simultaneously indicates the system itself is failing, not just specific components. The modern era's vulnerability to simultaneous multi-indicator deterioration emerged from the structural changes in how economies and financial systems were integrated following World War II and accelerated after 1971. The Bretton Woods system created synchronized monetary policy through the gold-dollar anchor. All major currencies were pegged to the dollar, which was pegged to gold. This meant that U.S. monetary policy effectively determined global monetary conditions. When the Fed tightened, global credit tightened. When the Fed eased, global credit eased. This synchronization created the possibility for simultaneous global economic deterioration if U.S. policy erred or if structural imbalances became unsustainable. The system worked during the 1950s and early 1960s when U.S. fiscal and trade positions were strong. But by the late 1960s, persistent U.S. deficits, fiscal deficits to finance Vietnam War and Great Society programs, trade deficits from imports exceeding exports, created dollar abundance that undermined the gold peg. Foreign central banks accumulated dollars faster than U.S. gold reserves could back them. The system faced a choice: U.S. deflation to defend gold convertibility, or dollar devaluation to reflect reality. Nixon's 1971 closure of the gold window chose devaluation. The immediate effect was liberation. Governments could run deficits, central banks could create money, and economies could avoid the deflationary adjustment that gold standard discipline would have imposed. But the long-term effect was to remove the mechanism that prevented simultaneous synchronized policy errors. Under Bretton Woods, gold outflows forced policy correction. After 1971, no external constraint prevented all major central banks from simultaneously pursuing inflationary policies or all governments from simultaneously accumulating unsustainable debts. The 1970s demonstrated this dynamic. The US, Britain, France, Germany, and Japan all experienced simultaneous high inflation, exceeding 10% annually in most developed economies by late 1970s. This synchronized inflation occurred because all were pursuing expansionary fiscal and monetary policies simultaneously, and none faced external constraints forcing correction. The oil shocks of 1973 and 1979 were triggers, but the underlying cause was monetary policy unconstrained by commodity backing. The Volcker tightening of 1979-1982 showed that synchronized monetary policy could also create synchronized recession. When the Fed raised rates above 20%, global credit conditions tightened. The US, Britain, and Europe all entered severe recession simultaneously in 1981-1982. Unemployment exceeded 10% in the US and Britain. The synchronized nature created global trade collapse, amplifying the severity beyond what isolated national recessions would produce. The key evolution was financial market integration, accelerating from the 1980s onward. Deregulation, technology, and globalization created a system where credit markets, equity markets, and derivatives markets were globally interconnected in real time. A problem in one market instantly transmitted to all others through arbitrage, hedging, and capital flows. This created efficiency, but also synchronized vulnerability. The 1998 long-term capital management collapse demonstrated this transmission. LTCM was a single hedge fund with approximately $5 billion in capital, but it had derivatives positions exceeding $1 trillion across global bond markets, equity markets, and currency markets. When its positions failed, the entire global financial system faced stress within days. Credit spreads widened simultaneously in US, European, and Asian markets. Stock markets fell globally. The Fed organized a bailout to prevent cascading failures across interconnected financial institutions. The 2008 financial crisis was the full expression of synchronized multi-indicator collapse in the modern financial system. 5 indicators deteriorated simultaneously. Housing prices fell 30-40%, largest decline since the Depression. Credit markets froze, interbank lending virtually ceased. Stock markets fell 60% globally, unemployment surged from 5% to 10%, and commodity prices collapsed. Oil fell from $147 to $33 per barrel. The simultaneity was not coincidental, it was structural. Housing price declines destroyed the collateral backing mortgage-backed securities. This froze credit markets as banks could not value securities or trust counterparties. Frozen credit forced asset sales. Asset sales pushed stock prices lower. Lower stock prices destroyed wealth. Wealth destruction reduced consumption. Reduced consumption raised unemployment. Rising unemployment reduced income and increased mortgage defaults. More defaults pushed housing prices lower. The cycle fed on itself. The policy response was also synchronized. Near zero interest rates globally, quantitative easing by Fed, ECB, Bank of England, Bank of Japan simultaneously, coordinated fiscal stimulus. This prevented complete collapse but created new vulnerabilities. Interest rates remained at zero or negative for over a decade in most developed economies. Central bank balance sheets expanded from approximately $5 trillion combined in 2007 to over $25 trillion by 2021. Government debt surged from approximately 80% of GDP average across developed economies to over 120%. This created the structural conditions for the next synchronized multi-indicator crisis. Extreme debt levels meant economies were vulnerable to interest rate increases. Even modest rate rises dramatically increased debt service costs. Zero rates meant central banks had limited conventional policy ammunition if recession occurred. Massive central bank balance sheets meant unwinding QE would reduce liquidity and potentially trigger asset price declines. All major economies faced these vulnerabilities simultaneously. The COVID pandemic triggered the most extreme synchronized policy response in history. All major central banks cut rates to zero or deeper into negative territory for ECB and Bank of Japan. All expanded balance sheets massively, fed from $4 trillion to $9 trillion in months. All major governments enacted fiscal stimulus exceeding 15% of GDP. The synchronized easing prevented depression, but created synchronized inflation when supply chains couldn't keep pace with demand fueled by money creation. The 2022-2023 synchronized tightening, all major central banks raising rates aggressively for the first time in decades, created the current vulnerability. The Fed raised from 0 to 5.25%. ECB raised from negative rates to 4%. Bank of England raised to 5.25%. Even the Bank of Japan ended negative rates. This synchronized tightening is creating synchronized credit stress, asset price pressure, and economic slowing across all major economies. The result is that, as of late 2025, 5 distinct indicators are simultaneously signaling stress in the U.S. economy specifically. But similar patterns are emerging globally due to synchronized financial conditions. The vulnerability is not unique to one economy. It is systemic across the integrated global financial system. The 5 economic indicators that have simultaneously entered historically stressed territory provide quantitative evidence of late cycle dynamics approaching critical thresholds. Signal 1, yield. Curve flat to 22 basis points. The Treasury yield curve shows 10-year notes at 4.67% versus 2-year notes at 4.45%, a spread of only 22 basis points as of late 2025. This configuration has occurred only 4 times before major economic disruptions. 1929, Great Depression; 1981, severe recession; 2006, financial crisis; and 2019, pre-pandemic recession. The 22 basis point spread is flatter than 95% of all historical observations since complete yield curve data became available in 1962. Normal expansion spreads average 150 basis points, reflecting term premium for duration risk, inflation risk, and opportunity cost. A spread of 22 basis points implies bond markets are pricing virtually no compensation for locking funds for 10 years versus 2 years. The signal is that markets expect near-term economic weakness will force the Fed to cut rates towards zero within 18-24 months. If 2-year yields at 4.45% are expected to fall to 1-2% within 2 years due to recession and Fed response, then 10-year yields at 4.67% represent an attractive lock-in despite low term premium. The curve flattens because expected future short rates are much lower than current rates. Signal 2, credit standards. Tightening for 18 consecutive quarters. The Federal Reserve's Senior Loan Officer Opinion Survey shows net tightening of lending standards for 18 consecutive quarters through Q3 2025. The longest sustained tightening in the survey is history, dating to 1990. For commercial and industrial loans, 48% of banks report tightening versus 5% easing, net tightening of 43 percentage points. For commercial real estate, 52% tighten versus 3% ease, net tightening of 49 percentage points. These tightening levels exceed those seen during the 2008 crisis in duration and nearly match in intensity. The significance is that tightening is occurring despite economic conditions that are not officially recessionary. GDP growth near 2.5%, unemployment below 4%. Historically, such severe, sustained tightening has always preceded recession within 12 or 18 months. Banks tighten because they perceive rising default risk, not yet visible in official statistics. The consequence is reduced credit availability. Banks that tighten standards reject more loan applications, reduce credit limits, and charge higher rates. This forces businesses to delay investment, reduces consumer spending financed through credit, and creates the conditions for economic slowdown that validates the initial tightening, a self-fulfilling dynamic. Signal 3, commercial loan balances contracting at 4.6% annual rate. Total commercial and industrial loans at U.S. banks peaked at $276 trillion in late 2023. By late 2025, balances have declined to $2.63 trillion, a contraction of $127 billion or 4.6%. Loan balance contraction outside of recessions is extremely rare. The only periods of sustained loan balance decline in the past 50 years occurred during the 1990-1991 recession, the 2001 recession, and the 2008-2009 recession. The mechanism is that loan balances contract either because banks refuse to lend a supply constraint or because businesses don't want to borrow, demand constraint. Current conditions show both. Banks are tightening standards, supply constraint per signal 2, and businesses are reducing borrowing due to high interest rates and uncertain economic outlook, demand constraint. When both supply and demand for credit contracts simultaneously, economic activity follows. The 4.6% annual contraction rate is accelerating. The decline was 2% annual rate in Q1 2025, 3.5% in Q2, and 4.6% in Q3. This acceleration suggests the credit contraction is intensifying rather than stabilizing, which is characteristic of the early stages of credit-driven recessions before the contraction becomes visible in GDP and employment data. Signal 4. Credit card charge-offs at 5.2%. Credit card charge-off rates, the percentage of outstanding balances written off as uncollectible, have reached 5.2% as of Q3 2025. This is the highest level outside official recessions since 1991. During healthy economic expansions, charge-off rates typically range from 3-4%. Rates exceeding 5% have historically occurred only during recessions or in the immediate aftermath when unemployment remains elevated. The significance is that charge-offs at 5.2% are occurring while unemployment is below 4%, its lowest level in 50 years. This combination, high consumer credit stress despite low unemployment, suggests that employed workers cannot keep current on debt obligations, indicating that real wage growth is insufficient to cover debt service, cost of living, and discretionary spending. Total credit card debt outstanding has reached $114 trillion, an all-time high in nominal terms. The combination of record debt levels and elevated charge-off rates creates risk of accelerating write-offs if unemployment rises even modestly. If unemployment increases from 3.9% to 5%, still well below recession levels, charge-off rates could spike to 7 to 8% based on historical relationships, forcing banks to write off $80-90 billion annually in consumer debt. Signal 5, S&P 500 at 21x earnings with 3% revenue growth. The S&P 500 index trades at approximately 21 times forward 12-month earnings estimates as of late 2025. This valuation is in the 85th percentile of historical observations, higher than 85% of all prior periods. Average expansion valuations are 15 times and 16 times earnings. Valuations above 20 times have typically occurred only during late-stage bull markets, late 1990s, 2020, 2021, or during periods where earnings have collapsed, but stock prices haven't yet adjusted to an 8 to a 9. The critical issue is not just the valuation level, but the growth rate supporting it. S&P 500 companies are projecting revenue growth of approximately 3% for 2026, near the bottom of the historical range. Earnings growth is projected at 8 to 9%, but this requires margin expansion, growing profits faster than revenues, that is difficult to sustain when wage pressures are persistent and pricing power is limited by slowing demand. Historically, Valuations above 20 times earnings have been justified only when revenue growth exceeds 7 to 10%, creating confidence in future profit expansion. When valuations are elevated but growth is low, it signals that either markets are mispricing risk or they are pricing in dramatic growth acceleration that is not yet reflected in corporate guidance. If growth fails to accelerate, valuations must adjust downward to reflect reality. The consequence of elevated valuation with weak growth is vulnerability to negative surprises. If revenue growth slows from 3% to 0.1%, consistent with recession, earnings could contract 10 to 20%. At current valuations of 21 times earnings, even a modest earnings decline would force valuation compression toward 15 to 16 times, implying stock prices falling 25-30% to reach historical average valuations at lower earnings levels. Convergence analysis. What makes these 5 signals significant is not any individual reading, but their simultaneity. Each signal independently has predicted recession or crisis with 60-70% accuracy in the past. But when all 5 signals stress simultaneously, the combined probability approaches historical certainty. The flat yield curve signals bond markets expect recession-forcing zero rates. Credit tightening for 18 quarters signals banks see rising default risk. Loan balance contraction signals credit unavailability and weak demand. High charge-offs signal consumer stress despite low unemployment. High stock valuations with weak growth signal mispricing or unsustainable margin expansion. If the yield curve is correct that recession is approaching, then the other 4 signals validate and amplify. Credit will tighten further during recession, loan balances will contract more sharply. Charge-offs will spike as unemployment rises, and stock valuations will compress violently as earnings fall. Each signal reinforces the others in a self-fulfilling dynamic. The simultaneous activation of 5 historically reliable economic stress indicators is not merely a statistical observation. It is a signal about the late cycle convergence of unsustainable conditions that have built over years and are now reaching critical mass. The first layer of signal is what the convergence reveals about policy effectiveness. The Federal Reserve has already begun cutting interest rates from 5.25% to 4.5% as of late 2025. Yet 4 of the 5 signals, credit tightening, loan contraction, charge-offs, yield curve, continue deteriorating despite these cuts. This is the opposite of how monetary policy is supposed to work. Rate cuts should ease credit conditions, stimulate borrowing, reduce stress. When rate cuts fail to improve conditions, it signals either that policy is too little too late or that structural problems exist beyond what conventional monetary policy can address. Historical parallels show this pattern preceding major crises. In 2007, the Fed began cutting rates in September, but credit conditions continued tightening through 2008 until the crisis forced zero rates and QE. In 2000-2001, the Fed cut rates aggressively, but credit conditions and stock valuations continued deteriorating into recession. The current failure of rate cuts to stabilize the 5 signals suggests similar dynamics, that the tightening cycle from 2022-2023 has already inflicted damage that modest rate cuts cannot quickly repair. The second signal is found in the divergence between financial market strength, S&P 500 near highs, and credit market stress, the other 4 indicators. Stock markets are priced for continued earnings, growth, and economic expansion. Credit markets, yield curve, bank lending, consumer debt are priced for contraction and recession. One of these markets is mispricing reality. Historical precedent strongly suggests credit markets are more reliable. They directly reflect actual lending, borrowing, and default behavior, while stock markets reflect sentiment, momentum, and liquidity that can remain disconnected from fundamentals for extended periods. The 2006-2007 period demonstrated this dynamic. Stock markets remained near all-time highs through October 2007, even as credit markets had been signaling stress since mid-2007 when subprime lending froze. The yield curve had inverted in 2006. Credit spreads had been widening through 2007, but stock investors ignored these signals until the crisis became undeniable in 2008. By the time stocks reflected credit market stress, the recession was already 12 months old and losses were severe. The third signal emerges from sector-specific stress concentration. The 5 indicators show particular weakness in specific sectors: commercial real estate, credit tightening most severe; consumer lending, charge-offs highest; small business, loan balances contracting most; and financial stocks underperforming despite market strength. These sectors employ tens of millions and account for significant GDP. When stress concentrates in employment-heavy sectors, the spillover to broader economy occurs through labor market deterioration, even if headline metrics remain stable initially. Commercial real estate stress is especially significant because CRE serves as collateral for vast amounts of credit. Banks hold $3.1 trillion in CRE loans. CRE also backs CMBS, repo lending, and private equity real estate funds. When CRE values fall 30-50%, as they have in office and retail, The collateral backing all this credit deteriorates simultaneously. This creates potential for cascading losses similar to residential real estate in 2008. The fourth signal is visible in the behavior of institutional investors and corporate insiders. Similarly, institutional money flows show rotation from risk assets, stocks, toward defensive assets, short-term treasuries, money market funds. Money market fund assets have reached $6.7 trillion, near all-time highs, despite stocks being near highs. This indicates institutional investors are holding elevated cash positions rather than deploying fully into equities, suggesting caution about future returns or elevated crash risk. The fifth signal appears in international capital flows and currency markets. Foreign investment in U.S. stocks and bonds has slowed significantly. Foreign purchases of U.S. Treasuries have been stable to declining, despite $2 trillion in annual new issuance requiring buyers. The dollar has remained strong on the index, not due to confidence, but due to other currencies being weaker. A cleanest dirty shirt, dynamic rather than genuine dollar strength. Simultaneously, foreign central banks continue accumulating gold, over 1,000 tons annually for 3 consecutive years. The combination of reducing dollar asset accumulation while increasing gold accumulation signals declining long-term confidence in dollar-based assets even while the dollar remains strong in relative terms. This is the same pattern that preceded the 1968 London gold pool collapse and the 1971 gold window closure. All 5 signals converge on the interpretation that the current economic configuration is unsustainable. The yield curve signals recession is approaching. Credit conditions validate this through tightening and contraction. Consumer stress validates through elevated defaults despite low unemployment. Stock valuations are disconnected from the credit and growth reality and must eventually adjust. The simultaneity means there is no offset, no strong sector compensating for weak sectors, no cushion absorbing the deterioration. Historical precedent for simultaneous multi-indicator deterioration is limited because such convergence is rare, but the instances that exist provide clear patterns for what follows. The 2008 financial crisis was preceded by multiple simultaneous signals during 2006-2007. Yield curve inversion, 2006, credit tightening, 2007, housing price declines, 2006-2007, stock valuations elevated at 18 times earnings despite slowing growth, and consumer debt stress rising. The consequence was the worst recession since the Great Depression. GDP fell 4%, unemployment reached 10%, stock markets fell 60% globally, and the financial system required unprecedented intervention to prevent complete collapse. The current 5-signal convergence differs in some specifics, but matches in pattern. The yield curve is flat, not inverted, but historically equivalent. Credit tightening has persisted longer, 18 quarters versus 8 2010 and 2007. Loan contraction is occurring earlier in the cycle. Charge-offs are elevated earlier. Stock valuations are higher. The differences suggest the current stress may be more advanced despite appearing less urgent than 2007-2008. For corporations, the consequence of simultaneous signals is compressed time to react. When credit tightens, loan balances contract, and funding costs rise all at once. Companies cannot gradually adjust through efficiency improvements or moderate cost cuts. They must make sharp adjustments, freezing hiring, cutting capital expenditure, reducing inventory, potentially laying off workers. These adjustments become self-fulfilling as multiple companies act similarly, creating demand contraction that validates the initial caution. The $3 trillion corporate debt maturity wall between 2025 and 2027 amplifies this dynamic. Companies facing refinancing at double previous rates, while credit availability is tightening and loan demand is weak, will struggle. Investment-grade companies will likely refinance successfully, but at much higher cost, forcing operational adjustments. High-yield companies, approximately 15 to 20% of public companies, face high risk of default if they cannot refinance or if business conditions deteriorate. Default waves create cascading effects. Banks holding corporate loans face losses that reduce capital and force further credit tightening. Bond funds holding corporate debt face redemptions as returns turn negative, forcing asset sales that push prices lower. Pension funds face funding shortfalls. The interconnection means corporate defaults don't just affect equity holders, they affect the entire credit system and institutional investor complex. For consumers, the 5 signals translate to reduced credit availability and higher unemployment. Banks, tightening credit card standards and reducing limits, force spending adjustment. Rising charge-offs cause banks to restrict consumer lending further. When corporations face credit stress and demand weakening, layoffs follow. Unemployment rising from 3.9% to 5 to 6%, well within historical recession ranges, would push charge-off rates to 7 and 8%, creating a feedback loop where rising defaults force more credit tightening, which reduces spending, which increases unemployment, which increases defaults. The consumer spending impact is substantial given consumption represents 70% of U.S. GDP. For stock markets, the consequence of the 5 signals is eventual repricing to reflect economic reality. Current valuations at 21 times earnings assume continued profit growth. If recession occurs, earnings typically fall 15-25%. At current valuations, earnings falling 20% combined with valuation compression from 21 times to 15 times historical recession average would produce stock market declines of approximately 45-50%, similar magnitude to 2008. The timing is uncertain, but the mechanism is consistent. Stock markets typically do not price recession until it is nearly upon them or has already begun. In 2000, stocks peaked in March while recession began in March. In 2007, stocks peaked in October while recession began in December. The lag is typically 0 to 6 months. If the 5 signals are correct that recession will materialize in 2026, stock market peak could occur anytime between late 2025 and mid-2026. For the financial system, simultaneous multi-indicator stress creates contagion risk. The 2008 crisis demonstrated that when multiple stress points activate simultaneously, housing losses, credit market freezes, equity declines, bank failures, the system lacks capacity to absorb all simultaneously. The Fed and Treasury can rescue individual banks or markets, but struggle when everything fails at once. The current vulnerability is potentially greater because central bank ammunition is more limited. Geopolitically, synchronized stress in the US combines with similar dynamics in Europe, weak growth, high debt, banking sector stress, and China, property sector crisis, local government debt problems, deflationary pressures. The synchronized nature means there is no strong external economy to provide growth offset through exports. Global trade is already stagnating, growth near 1% versus 7% historical, reducing the capacity for any nation to export its way out of domestic weakness. The consequence for monetary policy is the zero lower bound trap returning. If recession forces the Fed to cut to zero, and if recession proves severe requiring aggressive stimulus, the Fed faces limited options. QE, which creates inflation risk, forward guidance, which has limited effectiveness after repeated use, or coordination with massive fiscal stimulus, which creates debt sustainability concerns. None of these options worked perfectly in 2008, 2020, and all created side effects that contributed to current vulnerabilities. For individuals, the practical consequence is wealth preservation becoming more difficult. Stock market declines of 40 or 50% destroy retirement savings. Bond portfolios offer protection only if duration is long enough to benefit from falling yields, but rising default risks in corporate bonds offset this. Real estate faces declining values in commercial sector and potentially residential if unemployment rises significantly. Cash preserves nominal value but loses purchasing power if policy response includes inflation. The historical lesson is that when 5 independent indicators simultaneously signal stress, the signals are not independent. They are different manifestations of the same underlying imbalance. Credit tightening, loan contraction, consumer stress, yield curve flattening, and valuation extremes all reflect the same core problem. Debt accumulated at zero rates is unsustainable at normal rates, and the economy built on cheap credit cannot function without it. In August 2007, 5 banks simultaneously announced they could not value their mortgage-backed securities. The signal was not that 5 specific institutions faced problems. The signal was that price discovery had failed, that markets could no longer determine fundamental value because participants recognized the assumptions underlying valuations were wrong. Today, 5 economic indicators have simultaneously entered territory associated with recession or crisis. Yield curve flat to 22 basis points, seen only 4 times before downturns. Credit standards tightening 18 consecutive quarters, longest on record. Commercial loan balances contracting 4.6% annually, occurs only during recessions. Credit card charge-offs at 5.2%, highest outside recessions since 1991, and S&P 500 at 21 times earnings despite 3% revenue growth. Valuation growth disconnect signaling mispricing. Each signal individually has preceded recession 60 to 70% of the time historically. The convergence of all 5 simultaneously approaches historical certainty, not because any indicator is mystically predictive, but because each reflects actual economic behavior and credit dynamics that collectively reveal unsustainable conditions approaching resolution. The yield curve is flat because bond markets expect recession will force zero rates within 18 months. Credit is tightening because banks see default risk rising faster than pricing can compensate. Loan balances are contracting because credit is unavailable or unwanted at current costs. Charge-offs are elevated because consumers cannot service debts despite employment. Stock valuations are extreme because markets have not yet priced the economic slowdown that credit markets are signaling. This is not prediction about precise timing. The signals could prove incorrect. Growth could accelerate dramatically, validating stock valuations and causing credit conditions to ease. But this outcome has no historical precedent when all five signals align. Every prior instance of similar convergence, 2006, 2007, 2000, 1990, 1981, 1929, preceded severe economic disruption within 18 months. The mechanism is self-reinforcing. If the yield curve is correct about approaching recession, then credit will tighten further. Loan demand will fall more, charge-offs will spike as unemployment rises, and stock valuations will compress violently as earnings collapse. Each signal validates and amplifies the others until policy intervention arrests the cycle or economic exhaustion halts the downward momentum. For those positioned in line with official narratives that the economy is healthy, that soft landing is achievable, that current conditions can persist indefinitely, the five signals provide uncomfortable contradictions. For those attentive to historical patterns and credit market signals, the five red lights flashing simultaneously are not surprises but confirmations of late cycle dynamics that have been building for years. The signals have activated. The convergence is not subtle. Five independent measures of economic health are simultaneously indicating stress at levels historically associated with systemic breakdown. The pattern is consistent across history. The mechanism is mathematically certain. Debt accumulated at zero rates cannot be serviced at 5% rates without economic contraction or policy intervention that creates other problems. What remains uncertain is only timing. How many months before the signals in credit markets manifest in employment, GDP, and earnings data that force recognition. But uncertainty about timing does not invalidate the signal. It only determines how much additional risk is accepted by those who dismiss simultaneous warnings because the consequences have not yet fully materialized. Five signals just flipped red simultaneously. History provides clear precedent for what follows when this occurs. The mathematics provides certainty about unsustainability. The only question is whether this time will somehow prove different despite identical structural conditions, or whether the pattern will repeat with the consistency it has demonstrated across every prior cycle. The signals are not making predictions. They are revealing what has already occurred but is not yet visible in headlines. The credit stress is real. The loan contraction is real. The consumer defaults are real. The valuation disconnect is real. The convergence is real. What follows from this convergence has been consistent enough across history to approach certainty. Five red lights, all flashing. All simultaneously. The warning could not be clearer.